Hey guys, welcome back. In today's video, we are talking about taking down shorts, AMC saving money, how shorts are out of cash, and many more in this video. First, we're taking a look at this. So firstly, let's take a look at the comparison between AMC and its other competitors. So as you can see right now for AMC, and if you take a look here, AMC today is down 2.2%. But when you see here, you can see all competitors like Cinemark and IMAX to actually be up green on today. Cinemark is actually up 2.2% as of the day. Now, the reason why I'm talking about this is once again, we can see the comparison between retail stocks and institutional stocks. Firstly, AMC and Cinemark both have their earnings upcoming. Only IMAX have released their earnings. Now, with IMAX earnings, what we've talked about, it's how it's shown great prosperity within the industry, how it's doing extremely well, and what that would reflect and mean for companies like AMC and Cinemark. And so people are expecting companies within this industry to obviously do well, hence why we're seeing companies like Cinemark go up. Now, the same should of course apply for AMC as well, but it doesn't. And once again, this is just talking about the difference in the treatment between AMC and its competitors. It's talking about how institutions will do anything to get their stocks up, even though we are within the same industry and very likely going to be doing even better than them. And so you can take a look at the comparison. Like we've said, you shouldn't take the price action, you shouldn't take what the price discovery is right now to be a reflection of the performance of AMC, but rather when you take a look at its competitors, if you know that it's doing well, it means that we are also doing well because we benefit from the same things. If you see that AMC is constantly getting suppressed and manipulated, it also is a sign of the fact that we are doing well. Otherwise, the shorts won't feel the need to obviously suppress AMC. You can even see, if the SEC actually did their job and stopped these wash trading events, take away this very important tool they rely on, it will take down several huge funds and market makers. Virtue will be vaporized just like Knight was vaporized in a day, is why Dirty Doug has his minions. And so what we're looking at is how the SEC continues to ignore massive wash trading. Now, we've talked about this already, essentially how regulations in general has to turn a blind eye towards institution manipulating and exploiting any methods that should not be allowed. Once again, you can take a look at the comparison between AMC and Cinemark and IMAX. Of course, this is just a representation of how institutions will do anything for their stocks to go on. Bear in mind, Cinemark has 120% institutional ownership. Of course, AMC institutions will very likely to only have 5 or 10%. And then you also have to realize something we also talked about is how obviously AMC is exposing risk in $11 trillion world of indexing. So why is this relevant? Well, when you take a look at the fact, why are regulations ignoring these blatant and obvious clues that these hedge funds, that these market makers are manipulating the market? It's because they realize that if they don't allow them to manipulate the market, we're going to be seeing massive events unfold. And it's why they're trying to stop this by preventing it and by just essentially not stopping these institutions. And so we can obviously understand if the shorts weren't allowed to suppress AMC, weren't allowed to manipulate AMC, whether it's with dark pool, FTDs, anything that we talked about, spoofing, everything, all of these methods that we've mentioned in the past, then easily AMC and GME would obviously explode in price. And now, when you account for the fact that there are billions of synthetic shares created, at least for AMC at the very least, we will see how shorts will have to pay up hundreds of billions, if not trillions of dollars to obviously cover these shorts to buy it back. And so that's why the regulations have been trying to delay this. Now, we have always said this, the key word here is delay. It's not something that they can fully stop. It's not something that they can get rid of, but it's something that they can delay. They're hoping with the fact that retail gets out. It's why we always see these articles 5 years down the line telling retail to obviously try and get and sell your AMC. Don't buy any AMC. It's why we constantly see articles like this. It's because that's the only way for this whole thing to be stopped. Regulations, they can choose to not fine or to take any action, but it doesn't take away from the fact that there are still billions and billions of synthetic shares of AMC that are out there. And at some point, when they can't control it anymore, when they can't even turn a blind eye anymore, and it is exploding, that's when you'll see everything we've talked about will come true. That's when you'll see hundreds of billions of dollars, all this wealth will be transferred from the institutions to the apes, and that's what they are afraid of. Another big thing breaking, Federal Reserve cuts interest rate by 25 basis points. So why is this important? Well, first, let's talk about how this affects AMC. First, we have to understand is that AMC's debt will have now seen a reduction in their interest payments. We've talked about this. Every time we see a basis interest rate cut, we're going to be seeing a deduction in the interest rate payment. Now, this is obviously a very good thing because this allows AMC to have more cash on hand in which they can do multiple things. In this case, it would obviously to be investing, whether it's in their infrastructures, like the premium screens we've talked about, or whether it's investing into other companies like we've seen with Highcroft. But this is, of course, very good things for AMC. And it's why we've said earlier with the fact that we are seeing good news for AMC, whether it's the fact that the industry is prospering or whether it's the fact that AMC is seeing other indirect things that's benefiting their company. These are all things that are allowing AMC to grow. And that's why when we see prices like this, that does not dictate, does not showcase how we should actually be seeing AMC. We know that the price manipulation is happening. We know that the real price discovery is nowhere near what it should be, and that the price we see right now are, of course, fake. And you can even see here, not a coincidence. AMC and GME, the two tickers retail safe, just happen to have 60 to 80% of their volume hidden in dark pools. When nearly all the buying pressure is rooted off exchange, the price doesn't reflect real demand. That's not normal, that's control. They call it market structure, I call it manipulation. And you can see here, and just take an example, AMC, you're looking at 60 to 70, and right now we're looking at 77.95 with 24 million volume being hidden away. At days we've seen above 80, even 85% plus. GME 50 to 60. Now, when you take a look at some other ones, you're looking at it at a very low rate. You can see Charles Schwab is even at 30%. Now, the average is between 10 to 30%. And what we're looking at for AMC is 60 to 80. So almost 3 times of that, the normal market rate. And so this should already just show you how much manipulation is obviously going on. And we've said this, only 2.4 million shares really had an effect on AMC, whilst the other 24 million shares that were traded had no effect whatsoever. What's even more annoying about this is we understand the fact that out of these 24 million volume, not to say that it's full and all that is buy volume, but what we've seen in the past is that the majority of these volume that are in the dark pool are actually buy orders. And essentially it's just showing us that a lot of these buy orders are not actually having an effect on the price, even though it should be. Another big thing that we talked about yesterday as well, just in, short sellers are on track for their worst year since 2020. And we talked about this in terms of how important this is, how there are mutual short sellers, and this could obviously cause a chain reaction. And it's no surprise that we're seeing this right now, because if you take a look at the reverse repo, we saw it jump up to $19.5 billion. Now, the reason why this is shocking is because just recently we've seen it down at $2 billion. And we talked about how it's a countdown, and we talked about how this is already showcasing why shorts are cracking. And as we've said all of this, as we realize that shorts are in the need of liquidity, and if the reverse repo were to go to zero, they'll be all screwed, we suddenly see an injection of go up to 19.5 billion. So if this isn't a clue to whether or not these institutions, these banks, these shorts, these market makers are lacking money, I don't know what is. They are all in need of capital to finance their positions. You can even see here, US banks liquidity borrowing from the Fed repo rises to 10.2 billion, all developing as expected. The closer we get to cross 35 days of US shutdown, the higher the stress in the financial system. After we cross 35 days, we are in bank run's danger zone. And so you can see from multiple different aspects that we are not in a good position. And of course, when I talk about we, I'm not talking about the apes. I'm talking about, in general, the economy, because we're seeing stress happening. We're seeing banks who are in need of money. We're seeing institutions who are in need of money. Now, for us, the apes, and if we just talk about apes alone, this is obviously a good thing, because if banks can't get access to money, money, they won't be able to lend out towards these institutions. And if institutions can't get these loans, they won't have the ability to create new synthetics, they won't have the ability to finance their existing short positions. And if things go south for them even more, and we start to see them losing a lot of money, we're going to be seeing them covering their positions. And that's why we talked about how this is obviously a countdown. This is talking about how shorts are out of money very, very soon. And when you look at AMC, we are saving money and we are improving. As always, and this is F Financial Advisor. Do take our second growing. So make sure you do your own due diligence and research, and I'll catch you guys next time.